again. It's August 4th, the regular meeting of the Montana Board of Investments. Call the meeting to order. Lindsay, could you do a roll call, please?
Absolutely. Good morning, everyone. Carl England,
Here.
Jack Prothero is absent. Terry Cohe,
Here.
Bruce Nelson,
Here.
Diane Fladmo,
Here.
Maggie Peterson,
Here.
Mark Berry.
Here.
Jeff Meredith is absent. Daniel Trost is absent. Representative Ken Walsh
Here.
and Senator Ryan Lynch. I don't see him. All right, we have 6 board members present. We have a quorum.
Thank you very much. What's that?
By the skin of your teeth.
What do we want to do to the loan committee charter while they're gone?
Yeah, while they're gone. Add a few things.
Yeah.
Right, change the loan committee charter.
Had ideas all along.
No one over 69 can vote on the loan committee.
Wait a minute.
Can be chairman. Remember, we're recording this, which is probably why I shouldn't have just said what I said, but anyway. Any public comments, matters within the board's jurisdiction? No one seems to have their hand raised. We are at tab 7, the core fixed income asset review. Lady and gentlemen, take it away.
Thank you, Mr. Chairman, members of the board. We'd like to present to you some discussions around core fixed income. If I can refer the board to slide 3 of the presentation, I'll talk about what fixed income is. It's a contractual obligation to pay principal and interest over time. So that's as simple as saying, I'll give you some money, but I want it back at some point, plus a little something for the effort. So, you know,
Doesn't work with kids.
yeah. The key word is contractual. Willing buyer, willing seller, you know, consideration on both sides, no compulsion. I don't know. There's people that know contracts in this room better than I, so I'm not sure I got all the points, but for our purposes, what's key about contractual is that if you don't pay, we're going to court. That's how we think of a contract. And so that's different from most other asset classes where if you don't make money, well, them's the breaks. So bonds are issued by governments, corporate entities, special purpose entities. The coupons are contractually driven and they have interest rates, fixed and floating, generally predefined maturities and generally from a year out to 30 years or beyond. We're seeing 100-year stuff now. So the terms are generally standard, except there is some ability to negotiate. For instance, Kirsten essentially negotiates terms every morning where she might say, well, I like that piece of that commercial paper, but I'm not paying $275. I want $280. Or she might say, well, I don't like it for 30 days. I want it for 45. And or she might say, well, and I want a minimum interest floor on there if there's no minimum interest floor. So there is sometimes an ability to negotiate those terms, but
Can I ask a question about that?
yes,
How does that, I mean, we've had with Kirsten and you guys, the Bloomberg show of how you do it on Bloomberg, which looks to me like it's someone offers and you say you want it. How do you do, how does the negotiation work?
John, will you pull, well, I'll pull up the chat.
And if this takes you off topic, then.
Yeah, no, it's interesting because I think Kirsten was negotiating with Credit Suisse this morning, so let me just share this screen.
Do we want to show Kirsten's chat?
Well, the broker's chat, we can probably show the fixed income chat. Sometimes that goes a little far afield. But bear with me a second and I'll just share that because it's interesting.
At least to you and me it is.
Cool. And if it is what you say, Mr. Villette, it might be interesting to me.
There are sweaters. Let's just leave it at
Come to
that.
my office later and I'll show you the other one.
I want to see that. Thank you.
So on the screen there, you see a chat that Kirsten was in with Credit Suisse this morning. And she said, good morning, Sam. I thought, blah, blah, blah. Let's see here. Again, so up here you can, she said she would hit, it's as simple as her putting in the chat, hey, I'll hit the ISF for 25 million, but I want overnight at 233. And so, you know, she regularly is doing that. And then they might say, okay. And then she might either ask them, in this case, she said, hey, send me a ticket because the boom didn't work. Or she might in fact go to the boom screen that you've seen and hit it. And instead of them denying it, as they did probably before that, they would hit it. So it's as simple as that.
Boom stands for what?
What does send me a ticket mean?
So send me a ticket. We have lots of ways that we can execute a transaction. So to answer Maggie's question first, sorry, no reason for that. Boom stands for Bloomberg Order Management. And it's an electronic only money market trading system. And so you've seen that work. Yeah. When we say send me a ticket, we're not doing it off that. We're doing more of a negotiated transaction like Kirsten did on this particular security. And so to get it into the system, we have to have a process that will allow us to go through the pre-trade compliance management. And so
You are pre-trade compliance man,
yes,
internally.
right.
Okay, go ahead. I'm sorry. to interrupt.
Kind of what we always say is Tim says,
Tim
and we do
says,
it or
yeah, we
not.
gotta get Tim.
And so that's what's called a voice confirmation or a VCon. Send me a VCon ticket.
So I see the exchange. Did she get them or not?
Yes,
So for that exchange, she knew she got it.
yes. And we know she got it because we'll actually see the trade pop up on our screens.
Oh, they say it's gonna cost. So yes, I'm gonna do it. And then she says she could take more if there's something longer.
Yeah.
Okay. I guess I don't speak bond that well. Okay.
Right. Well, yeah, right. A lot of shorthand, 'cause
Yeah.
especially for Kirsten right
Yeah.
now. She's inventing shorthand as we go.
So, and then from that point on, then it goes, I mean, it goes through the Bloomberg system. It might not be their standard system. It might be because there's a ticket as opposed to the EOM.
So boom is, everybody can see, everybody that's trading, so all the other people like us that are out there looking for stuff, if it's put on boom, anybody could hit that trade, right? So when she's negotiating something here, they'll send that VCon ticket, as John's saying, directly to us because she negotiated that directly. And you don't want to just put it on boom because then anybody could hit that. So it's a more direct relationship at that point.
So
So pretty typical.
It's what?
It's pretty typical.
Uh-huh.
Happens all the time. I'm sure everybody else does similar things.
Okay, I interrupted your flow and I apologize.
not a problem. So that's, yeah, that's kind of how we would negotiate it. There are other ways to do it. But I wanted to go on to page slide 4 and talk a little bit about some of the terms. I'm not going to go through all of these terms because it would be boring. Just want to highlight a few, principal. So when we say principal, we mean the initial size of what what the bond will pay at maturity. So that's par or principal. That's when par and principal are the same as when the bond's issued and based on what it's at maturity. The coupon is the periodic payment, the little something extra that we want when we lend money. So that's the actual cash that's sent to us, and it's based off an interest rate or a floating rate that's referenced to an index, and that index might be Fed funds rate, it might be prime rate, it might be secured overnight financing rate, or so for some of the indexes you've probably heard of. Going on to page 5, wanted to mention duration. So you hear us talk about duration in every presentation. And so duration is a measure of a bond or a portfolio sensitivity to changes in interest rates. As the duration increases, the bond or the portfolio sensitivity to interest rates changes increase. Weighted average life or maturity is the measures of how quickly the outstanding principal will be repaid. A higher weighted average maturity or weighted average life, we call it WAM or WAL, the longer it'll take. So I wanted to mention that because we're in a period of rising interest rates, or generally rising interest rates. And so for some of the participants in our programs, namely the trust fund investment pool and the STIP, they won't see, interest rates might go up, but they won't see an increase in their distributions for a period of time related to that. And so the old bonds have to pay off and those proceeds be reinvested in new bonds for them to see that. So you cannot change the portfolio's yield by selling an old low coupon bond and buying a new high coupon bond, because the dollar price of the old bond has fallen. And so you don't get as many dollars to reinvest in the new bond. So that's why you can't just simply churn your portfolio and increase the yield. Going on to terminology on page 5, yield to maturity. So you have the coupon and those are generally set, but the yield changes because the underlying value of that bond changes. So you might buy a bond with a 5% coupon. You might buy it at par at 100. And then in that case, you've got, did I say 5%? You got a 5% yield on that. You bought that at a 5% yield. If you bought it at 90 cents on the dollar, then your yield might be 6%. My arithmetic isn't going to work out there with me. Yeah, or you might buy it at 110 and your yield to maturity would be 4% on that bond. The yield curve, you hear me complaining about it mostly and how it hates me, but that's a set of yields based on maturities plotted over time. And so we'll talk maybe a little bit more about yield curves, but as Jim mentioned yesterday, the yield curve is currently inverted. So that makes positioning difficult.
Okay, so explain the inverted yield curve for us.
So why not just look at it? Because we got this thing here. So bear with me a second. All right, so took a little while to pop up, but Mark, you can see there 2 yield curves. The green one is today's yield curve, and the I don't know even what you would call that, bronze colored one was what it was at the end of last quarter. So we can see in this case the highest point on the yield curve is the 1-year yield. The 1-year these are treasuries. I'm sorry, these are treasuries based off just US treasuries.
We actually can't see it, can we? Because it's
Oh,
covered.
sorry,
by
I
the-
got my thing in the way.
Well, it's actually Dan's.
It's
If
actually
it's down,
Dan's.
it's got stuff in the way.
Oh,
No, it's just the big, the,
Uh,
doesn't matter, we,
yeah, I can't.
yeah.
I
Elsie,
don't know how to
go-
do.
will you go move Dan's thing?
No.
But you can infer
Takes a
from the,
woman to save every man.
so, but Mark, you can see, oh, thanks, Kelsey, directionally that the highest yield is at the 1 year.
Oh, that really, I'm glad you moved it because it's in that quarter. It really moved, didn't it?
Yeah,
Wow.
yes, it did. And this is just the quarter to date. So it's really just almost really the month of July that we saw such a strong move, but so it's not inverted from every point. You can see it bottoms out in the 10-year range and then goes up a little bit to the 20-year range.
But what you would expect is for it to go like this.
Yes,
The
normal.
longer, not the duration, the longer the
In this case, maturity.
maturity,
Yeah.
the higher the yield.
That's generally what we would expect, and there's, can be steeper or flatter, but generally we would expect an upward sloping yield curve. When it inverts, as Jim mentioned, sometimes it's a good signal for a recession, but not always. And so when we're thinking about it, it inverts, in my opinion, because the Fed moves aggressively on the front end, inverting the yield curve, and they cause a recession by doing that. So it's not per se the yield curve that causes the recession. It's driven by increased front end interest rates. Sorry for that diversion, but that's good. No, let's just, we can go as far afield at any time. Objectives of fixed income on slide 7. First objective is total return. So total return is income plus a change in market value. Did the value of the portfolio go up because interest rates went down, or vice versa? Over the long haul, and for most of our clients, income is by far the more important factor in total return. It also provides diversification in that last quarter, last year, not a great example of that diversification, but usually it has a different investment profile than other securities. And it provides liquidity. So sometimes, thinking about that liquidity, sometimes we mix and match liquidity and diversity. John might talk about the fixed income being a source of liquidity when equities are down. And if we think of liquidity in strict terms, well, the most liquid market in the world is probably the equity market. He can go out and sell or buy 100 million in a matter of moments and not affect the market. But so that's a case where he might not want to do that. Instead, he might want to sell fixed income, which hasn't fluctuated. In other words, has been more diverse than equities. So that's when we get those mixed up. But I always think of liquidity in relation to the bond portfolio as what if we did nothing? So if we did nothing, obviously the stocks would yield, S&P yields about 1.5% right now. And so we get money into the pension funds from stock yields. Bonds, same thing, we get coupon payments. But the difference is that bonds mature at par. So that will continue to throw off significant amount cash that John can use, either to pay pension benefits or to reallocate. So that's what the value of liquidity in the context of the fixed income portfolio is. So on page 8, wanted to talk just briefly about.
Can I ask a question?
Yes, sir.
So yesterday, when you presented the performance of the trust fund investment pool, right? For the year, you got it down 2.8%, the value of the pool.
Right.
But that doesn't, this is my question, that doesn't necessarily tell us whether or not the participants of the money are getting the coupon value and getting paid out of it. Is that, do you understand what I'm?
Right.
Yeah, their distributions.
So distributions in the trust fund investment pool have been declining for a long period of time. Because bond interest rates are.
Because the interest rates are low,
Right. So long-term secular decline in interest rates.
right?
And we're stealing this from a little ahead, but we could talk about slide.
Well, if you want to, if you don't want to.
No, let's go to it. I mean, 'cause, you know, who wants to talk about duration? Slide 17. So this is the yield on the index over time. And you can see over time, we've seen a long-term general decline in interest rates, and the trust fund investment pool participants have suffered declining yields.
Right.
And so you'll recall that you as a board took some steps to deal with that. And by far, the most major step that you've taken was in 2020 to dramatically increase the allocation to real estate. From, I believe, the max of 7 to a max of 30. And with the understanding, our intention was to go as quickly as practical towards the top end of that range. So when we were presenting some of those facts to you, I had projected that even if we did that, based on what we thought our pacing would be, we were going to continue to see declines in distributions through 2025. So, but for this last fiscal year, the fiscal year ended 6/30 of 22, we saw a very small increase, 15 basis points. Wasn't much, wasn't a lot for Dan to take to the various constituencies and stakeholders and say, see what we're doing, but again, we had been projecting declines. So,
But the participants get their money from the interest, right?
and from the distributions from the real estate partnerships.
Right, but I mean, in terms of the bonds, they get their money from the interest.
Yes, and so, I'm sorry, go ahead.
No, I was just gonna probably finish what you were gonna say.
So I wanted to nance around interest a little bit. So we have a market yield and a book yield, or what I'll term distributable book yield. So in the context of where I said, well, we bought a bond that with a 5% coupon, but we bought it at 110. So the participants don't get that 5%. They get that 5% less the amortization of that price above $1. So we take a little bit of that away, so that when the bond matures, it doesn't mature at a gain or loss.
Can I follow up? 'Cause I think the question you were asking or was, as I understood it was, so we had negative 2.8 return, okay? We had distributions. Those distributions are counted in that negative 2.8. So the value of the bond the portfolio went down more than 2.8, but the distributions pulled that up, or am I thinking about it wrong?
So there's no real short-term correlation between the total return of the portfolio and the distribution.
That was my
Okay,
question.
that's what I was trying to get
That was
to.
my
Yeah.
question.
In the long term, obviously, they're gonna.
Right,
manage.
because you got less money.
So it's
Right, but
really
in the
what-
short term, they still get their distributions off of the great bonds you bought 3 years ago.
But the 2.8 is if you sold the bond today versus the beginning of the quarter, what you get, that's where the 2.8 negative comes from, correct?
Right.
Gotcha. Thanks.
When it's going down, we don't try and keep it level. Understand my question? It's a
Yes.
trust fund, the principal is inviolate, right? And if the value of the principal goes down, then the value of the principal goes down. We don't use the interest to build that up. Is that right?
Oh, correct.
Okay.
So, I mean, obviously, we're aware of that, and our goal is to have higher distributions.
Right.
But again, there's nothing we can, declining interest rates, we can't sell bonds and buy
Right,
bonds to
okay.
offset that.
All right. Thank you.
You bet. Thanks for the questions. It's way better to do it that way.
Go back, John, because you said at the beginning of the answer to Carl's question here about that when we made these, said okay to going up to 30% real estate, that you projected at the time that even with that transition period, I believe that we would still be looking at it would shrink until 2025.
Right.
So we saw what, minus 2.8 in the last year. What are you projecting now? What, are we still on that path that even with that transition to real estate, you still feel that we're looking at decrease for the next 3 years, or?
No, now we would project increasing distributions
Because-
from going
because
forward.
We've got curve up in the last 6 months.
It'd be more because
I'm
of-
sorry, I didn't catch that.
Well, the rate right here.
Yeah, right. So a little bit from that, Bruce, but that takes a while to work through
Yeah,
the portfolio.
yeah, I mean, yeah, I understand you can't roll it over
But it's
on a
really
daily
the
basis
higher
and
return
increase the
real estate.
value because you're selling lower value stuff to buy higher value stuff, even though the yield is higher.
Right.
I think I said that right, maybe.
Well, we certainly knew what you meant, even if you didn't say the exact words, so.
I'm
But
glad you understood what I meant.
But as Terry said, the real reason for that is the higher that we went into real estate. We felt we had good opportunities in real estate and we went in much heavier, quicker than we had originally projected, and that increased the
And
yields.
that's also helping.
Yeah, that's the main
Yeah,
factor.
that's
The main factor.
But this over time will help as well, if it holds up, right?
So I take it then the answer to the question is you're no longer projecting continued decline to 2025.
Okay, let's, I don't know, we've had enough terminology, right?
Right, I think you were getting to page 8, right?
All right. Yeah, so I think we talked enough about changes in interest rates and risk factors and how there's an inverse relationship as is graphically demonstrated very well by John Putnam on page 9. So again, interest rates go up, value of the portfolio goes down, interest rates go down, value of the portfolio goes up. And again, we can measure that, and that measurement is duration. So the duration of portfolio is roughly 6 years. That means if interest rates go up 1 percentage point, the value of that portfolio will go down 6%. So that's how we measure that, and that's numerically what we mean by duration. Going on to slide 10, just wanted to talk about the core internal fixed income portfolio. So core fixed income we have across the numerous clients. This is an accumulation of all of the core, in other words, investment grade fixed income that we manage internally. So that's what we're talking about here when we say core internal fixed income. About 12.5 billion at the end of the fiscal year. You can see that the large majority of that is in STIP, but some fairly significant investments in other portfolios. On the right-hand side, you can see a table of the transactions that we have to do to keep up with that. And of course, there again, you can see the vast majority of those transactions are from STIP. But then you can also see there's quite a few other transactions, both in terms of number and in terms of size.
So this is where I saw the 57 million, and I thought I saw the 78 million, but the 78 million is just transactions during the year, right? That occurred in the STIP reserve. Because you said that, might have been wrong. but I
Oh,
remember
okay,
seeing this.
yeah, right. Yes, now I'm with you, Mark. That's where that figure came from.
So let me ask a basic question here. Other than the fact that you all are so good, why is it that we can internally manage our bond funds than we externally manage the stock funds?
Yeah, so I'll make a couple of observations and then turn it over to my superiors. Um, I waved at the entire team. Don't leave John out of that. So, well, why do we do it? Well, one reason is we think that the bond market is less efficient than the stock market.
Is less
Efficient. That means that we can profit by making trades ourselves.
Because it's not as widely known.
So-
Less efficient.
Yeah, that seems counterintuitive.
Right?
Yeah.
So if,
It's less efficient, but you take advantage of that
Right, because
inefficiency to make money is what you're
it's
saying.
like that argument we're
That,
using on.
that negotiation Chris did that you showed us on the screen is an example of that, correct?
right. Right.
Well,
And
this
I
is-
think Jim wanted to.
Yeah, I did. This is what he just said, that the bond market is less efficient, certainly than the large cap equity market. It has borne out to be true. If you look at our active passive study, active management in the bond area has tended to have a high probability, not perfect, not guaranteed, but a higher probability of producing excess returns versus the index. Why is that? Because there are over 12,000 bonds in the universe, many of them in smaller to medium-sized lots, many of them not researched, and they end and are replaced by other bonds constantly on a daily basis. So unlike the equity market, particularly the large cap equity market, where There's very little turnover in the names. Most of the names are heavily researched, and there's a single security that represents the equity interest in a company. The bond market is nothing like that. So we would agree with what your staff just told you. So I'll stop there.
So that answers a question that maybe you didn't ask, but I answered anyway. Why should we do
Right,
it? And so then the question of how can we do it?
right.
Well, we have a lot of tools and we're going to show you some of those tools. But we also have a philosophy that John and I have had for 15 years probably, that we are not going to try and be the best traders out there. Instead, we are going to try and obtain a set of securities that don't blow up in our face. And and that's we believe that that's where that we can do that efficiently. If we just don't, an example might be Pacific Gas and Electric. We had on our approved list, as you know, they had some disastrous fires in California. And we found out that the world found out it was started by those their own transmission lines. And the value of those bonds fell. We didn't actually own the bonds at that particular time. And so you might look at some research companies and they said, well, based on what we're projecting, we think the value of these bonds are really 98 cents on the dollar. John and I said, no, we're not going to project a recovery. We're getting out of this because we are not going to look at a bond that has what we would call a binary outcome, par, zero. And so we took that company off the approved list. And so we have, in terms of corporates, in the long portfolios, we have 110, 120 approved names. So let's say 30 names a piece for us to cover. Obviously, we cover other types of securities, mortgages, commercial paper, asset-backed securities, but again, working with well-known entities, and if we look at, say, an asset-backed security that we might buy, we believe we make our money by being in the asset class, and so we're going to be in the AAA stack. We don't believe we're going to make our money by going down in that stack to the double B. That's double line. That's
Okay, but
flat
there's more
rock.
yield at that level.
There is more yield.
And so, then why don't you believe you'll make money at that level? Are you looking at that
We believe we'll make most of our money,
at the AAA?
and then we don't think we're sufficiently rewarded
To take the risk.
to take the risk because we don't spend our resources researching that piece.
We have active managers that we hire to do the.
Yeah.
To do the.
Right.
So we play in that space, but exactly right, Terry.
But you have
We have active managers in areas like that where we don't think we have the resources to do that kind of deep research, and that's our high yield managers, that sort of thing.
Okay, so then that goes back to your
If I
question.
could,
Wait a minute,
Why
I
can
can
these
jump
people
in.
do it better?
what's that? Wait a minute, hang on for a minute, Jim.
Why do we feel
no problem.
people do it rather than hiring managers to do it?
Because, and it seems to me that the answer from a layman's standpoint is because you've basically put some significant limits on what it is that you're looking at, consistent with your philosophy, consistent with the fact that, number one, we have a manager that to look at the other stuff, consistent with the fact that it's part of a larger portfolio in in cap. So, and then consistent with the philosophy that we're not looking to hit the home run here, we're looking to be, get some yield and not have a blow up. Is that fair?
cheap compared to an external.
And you're cheaper.
Right,
Of cost wise,
yeah,
not,
and,
not value wise.
and, I'm sorry, go ahead. I was gonna say, and apologize to Jim Boyko, I just got one small thing I would, and additionally, for instance, John and I sit next to each other, so he, you know, he might say, hey, I'm looking at maybe, I gotta pull 75 million from you tomorrow, or maybe 10 days from now. So John and I have probably already come to an agreement about how much risk we want to take
Right.
inside that portfolio. You couldn't really do that effectively with an outside manager. He couldn't say, hey, I'm not loving risks now. Will you take our contribution to duration from corporates down to 75% of the index? So, sorry, Jim.
Jim, sorry.
No, that's all right. You know, when you look at the internal management that happens at asset owners like yourselves, the three areas where it's most common is cash, core fixed income, and sometimes indexed equity. I said yesterday that your core fixed income team, in fact, your fixed income team generally deserves a tip of the hat, but part of the answer as to why they can do as well as external managers in their philosophy is one, fees, you mentioned that, and two is that they don't have to worry about going to outside to market other assets. They're staring across the table at their single client, that is this board. And so their desire and their need to take risk, to try to look better, to look sexier, if I could use that phrase, than their 100 competitors is not there. And so they can afford to follow a strict quality regimen that John and the staff have laid down, and it has paid off over time. So they're simply in a different paradigm than an external manager. Now, the external managers have the advantage in that they are much more broadly and deeply engaged in the market, and they have much deeper research resources. And you guys have used external versus internal in a balanced way for just that reason. So I'll stop there.
Thank you. Thank you.
I guess just a couple of things I might add to that would be, A, we've done core fixed income, obviously, for as long as I've been here and much further back. So we have sort of that, base of talent. These guys do an incredible job, and John's being modest about the PG&E thing. That was totally his call, but he comes at those things from the right perspective in that, bond market, and he's exactly right. It's a binary outcome, and the worst thing you can do in the bond portfolios is take a 0 on something, because that is pretty hard to overcome when rates are 1% or something. But I think the reason, two other reasons, I guess, kind of broadly, that I think we can do this, aside from having the talent and the tools, is we have size, we have considerable size, and a lot of that is based on, the structure of sort of MBOI broadly, that we have all these other portfolios. Most of the portfolios outside of pension, as you can see here, are a lot of core fixed income. And so, that gives us some buying power with the brokers on the street. The other thing, in fairness, is that, yes, the bond market is inefficient for all the reasons they've mentioned, but the index is also relatively inefficient. So from a manager perspective, I wouldn't want to go out and necessarily, buy the index, if you will, and you can't, because it's an over-the-counter market that's, very much unlike public equities, where, yes, I can go buy an index, it's perfectly replicated, and it's a basis point to go do that with, BlackRock or something. That is not possible in the bond world. And so doing it in-house makes all the sense in the world, and making, as we always have, bets, I guess, if you will, around the index, but also, having that ability, as John said, to manage our risk in-house and have those conversations and say, boy, things are getting rocky. Let's maybe have a little bit more treasuries or what have you, and making sure we're comfortable with that. And you see that in the results sometimes of, we may not look like peers. A lot of peers, it's unclear to me, Jim can probably speak to this better than me, but sometimes when you look at that peer ranking, we may not look good in the go-go times, because I think they're actually including a lot of sort of plus type sectors within their quote unquote core fixed income. We are core fixed income in our core fixed income portfolio, and that gives me some sleep good at night when things are going poorly. I know what we have, I know what we can tap, and so do they. So,
But just to go back, you guys are focused on AAA or government type areas, right? That's where you strictly.
I might have misspoke there, Mark. I was referring just in the case of asset-backed securities,
Okay.
but we will buy down into BBB rated corporate bonds.
All right.
Yes, sir.
Make sure that I just understand all my acronym here. TIPS, is that Treasury inflation protected?
Security.
Oh, 3.5 years. I finally got one down.
And so that asset actually exists in the real asset class. So it's kind of funny. Is Ethan my boss because I manage tips for him, or am I his boss because he manages real estate, or does it not really matter? We're members of a team. I think it's more the latter.
How individuals can only buy, is it 10,000 of tips a year or something? There's a limit,
Well, I'm sorry, go ahead.
but there obviously isn't a limit on institutions, or my misunderstanding.
Yeah,
We're
so-
talking about different things.
So that's an I bond.
Oh, the I bond.
Or maybe it's an E bond.
No, it's an I bond. It's the I bond.
But individuals can only buy 10,000. Can you buy those, or is tips? So it's for the individual investor.
I don't think institutions can buy I bonds. I am not positive about that.
I asked Kirsten when it hit 9.7 in May, and I asked her to go buy $10,000 for every Montana, and then she said no.
I did like, can't.
She said no, or she said you can't? That's a different.
It went on from there.
Yeah.
You said, no, you can't.
Oh, okay.
Oh, okay. Thanks for the questions. It's makes for a much more interesting presentation for me, at least. Just wanted to go on to slide 11 and talk about some of the non-pension clients. You can see the listing here. We got about 47 listed there. Usually 1 or 2 a year, as you know, from us coming to you saying, here's a new policy statement for this new account. And it's interesting that the large majority of the assets are in operating funds. Think STIP, think Treasurer's Fund. And the largest number are in the expendable funds. And those are, I believe, without exception, environmental remediation type of funds. And so I think because they're expendable, they require a little more effort, a little more close contact with the clients, but close to all of our hearts probably. So happy to do that. So when we construct a policy to bring to you guys, how do we go about doing that? Well, usually we do rock, paper, scissors among the people who has to do it, but we've been doing it for a while, so we got a pretty good system. We developed the portfolio objectives and constraints in consultation with the client, and that's what are your cash flows look like? What are your earnings requirements? Things like that. We choose the appropriate benchmark and then define the investment guidelines. Then at that point, we come to you guys and say, does this look okay? And you might say yay or nay or close, but make a few changes.
Who do you deal with on the severance tax fund? Full
So
severance tax fund? I mean, who's the
that
client
actually
there?
is the Department of Administration.
Thanks, that's all. No. I'm just curious, because I mean, all these others obviously have.
You know,
It's pretty
it's-
obvious who it is.
You asked the question who, and it's interesting. That is one of the more difficult things that we deal with is maintaining a relationship with somebody as those position turn over. And in fact, we've had clients come to us and say, hey, this Zortman Landusky account, what is that? And so we have to explain to them their history of how that came.
You're telling the agency people their job, sort of?
Yeah, so, and so, yeah, so,
Okay.
and they're diligent people, you know, in that case, it's a new, you know.
Right, somebody new comes
just
along
turnover
and
happens and those things.
they didn't get the word, so they come to you.
And they don't have anybody that
Right.
knows anything there, and but we do. And we, everybody on the team is primary responsible for some accounts. That means they're the point of contact. They are in charge of making sure that they have enough cash, making sure that they have enough yield, talking to the rest of us about that client, and every one of us is a backup to them. All of us are backup on some accounts to somebody else. So all of us are primaries and all of us are.
Oh, I see. So every fund, you've got one of you is primary and one of you is secondary.
Right.
I get it.
And so it's not just me primary and everybody else a backup, or me and Kirsten primary and everybody else a backup. It's
Right.
like Kirsten, Kelsey has all the DNR, or all the NRDP accounts. And so, and I back her up and I'm happy to go to meetings with. She tells me, hey, we need to buy $50,000 in the Upper Clark River Basin account. So, yeah, so we monitor those, you know, really on a daily basis, but more officially, at least on a monthly basis, when we do trust fund investment pool transactions, that can only be done once a month. And so, yeah, I would just finish off by saying, you know, we continually search for efficiency and improvements, you know, the electronic trading, systemic credit research process, Bloomberg data. So I wanted to talk about, you know, what are the types of investments that we might put in a client's account or.
Can I ask one question before you do that? So the individual securities, I presume, in the trust funds, right?
No, so well, yes, trust fund is made up of individual securities.
No, but I mean, you've got, I mean, for the non-pension clients, you got money in STIP for their anticipated needs, right? And then you got most of it, the rest of it invested in the trust fund investment pool, right? And then you've got some individual securities. We always see them on the spreadsheet and they're just sort of hanging out there.
Right.
So are those securities that someone gave as part of the, you know, the initial setting up of that fund?
No, so those would be securities, for instance,
Okay,
in the treasurer's fund. As of a year ago, it was all in STIP. But when interest rates on the short term went up, well above STIP rates, we decided, well, we're going to buy some 2-year treasuries in the treasurer's fund.
Okay.
And we might do that in some other funds. For instance, Kirsten manages the U of M fund. And so they have cyclical needs where she might purchase a treasury or an agency to a specific date.
For that specific fund and just for that specific.
Right.
I get it. Okay.
And so they're used sparingly because of the effort of, if we were to do that for all funds, it would be difficult both in terms of effort and to achieve sufficient diversity. But sometimes it makes sense and sometimes it makes sense. For instance, if the Beltwater treatment plant knows that in 3 years, the sludge pump's gonna go out and they're gonna replace it in 3 years, and we might buy a particular security to match that so that they're not forced sellers of the trust fund investment pool at that time, but yet get a little better yield than they might otherwise get instead.
I get it. Thank you.
I think that kind of knocked out the types of investments and why we use them.
Was that good?
Yeah.
I mean, I don't want to get in trouble with.
We talked about our efficiency, but you're really getting me through this.
That was totally by accident. It wasn't a, hurry up, John, we're getting impatient. That wasn't that.
Okay, I think slide 16, we've talked about the trust fund investment pool. We also, thank you, Bruce, got through slide 17 in a pretty short order. And I would like to turn it over to John Carpenter to talk a little bit about STIP.
Yeah, so good morning,
Good morning, John.
Chairman, members of the board. When we're talking about STIP, there's clearly 3 objectives. So one is preservation of principal. When they give us $1, the expectation is that when they need that $1, we can redeem them for $1, not 97 cents. So clearly that's the first principle. The second is liquidity. So we have benchmarks, both daily and weekly liquidity measures that we manage the portfolio to make sure if University of Montana comes and says, hey, tomorrow we're writing a $50 million check, super, we have those funds maturing or assets that we can sell to meet those demands. And then finally is return. When you give us $1, hopefully you're getting that little smooch is the technical term that we use. A good example of that. So for fiscal year 22, so we just ended that June 30th, the STIP portfolio earned 32 basis points for our participants. Big whoop, right? Happily, in August, we've hit that 2% mark. So if we kind of do some math on that, that extra 168 basis points works out to $125 million a year for participants in STIP. So certainly we benefit from the short duration, the rising interest rates. It's really been dynamic in STIP. I can say a year ago it was, well, it doesn't really matter what we buy because it's 0. So or it's 2 basis points or it's 25 basis points. Now we have the opportunity. We've actually bought some 1-year securities at 4%. When we look at core fixed income, we could buy a 30-year for 2.9%. STIP is able to realize up to 4%. So we're excited about that. Right? Is excitement the right term?
Yes,
So
perfect.
Kirsten's here to keep me in line. Moving on to the
Kirsten's
next.
here to keep all of us.
Yes, absolutely. Just some statistics looking at STIP. Again, we talked about this in February. All securities are A1, P1. We only buy the highest quality again for that preservation of principal. We want to make sure we get our $1 back at the end of the term. Diversified over asset classes, so primarily asset-backed commercial paper. We also buy treasuries, money market funds, corporate paper, Weighted average life is currently, well, as of 6/30 was 77 days. This kind of goes back to, we asked for, when interest rates were near zero, asked for an extension of the policy limit from 60 days to 120 days. Because of that flexibility, we're out to 77 days, but again, that enables us to buy some longer dated stuff and yield 4% versus the shorter stuff. Again, duration 0.18 years. So we are more dynamic. We can reinvest those funds as the Fed keeps cranking the dial. Daily liquidity we talked about, government agency. So that's that piece. I did want to divert this presentation just a little bit to show you kind of how we're managing STIP. So as a continuation of operations, John's bad burrito, or as we've defined it now, the retaining wall scenario. I want to make sure that God forbid something happened to Kirsten, that, you know, cash movement is probably one of the single most important things that we do at the board. We don't want the state of Montana bouncing checks because, hey, we're all out today. So, and again, it's $51 billion in transactions. So we need somebody to occupy that seat. So I've been trained in STIP for over a year now. I believe Kelsey's approaching a year. So we've also changed it to where Kelsey and I stay sharp on STIP. So we alternate Fridays. It also enables Kirsten to get a little bit of her week back. And we've even let Ramasco drive as recently as a couple weeks ago, and he didn't break anything. So, you know, 4 members that can step in at a moment's notice and manage the portfolio. As part of the modernization, so this is how we used to manage STIP, right? Beautiful maroon binder. We pencil in what we have, what we bought, maturities, which worked great when it was just Kirsten, right? And when everybody was in the office. Through the pandemic, we've needed to have flexibility. So if I'm working from home or, oh crap, all of a sudden Kelsey has to cover, that she can see what cash flows we have going. So what we came up with is using technology. We've integrated the STIP portfolio. So this is just your standard Outlook calendar. So we're looking at a month view. What we do on a daily basis is take that Bloomberg data of the securities that we own and we import it into Outlook so that we can see, you know, out to infinity. We don't buy anything more than 2 years, but we can go through the calendar and see both maturities, any planned outflows, any big inflows that we might have coming. Go back to the month view.
So there was a negative number on the first, I guess.
Yep, so like on where my cursor is now, we pay the workers of Montana, which we appreciate, every other Wednesday. And so we have those penciled in so that when we're buying and managing the liquidity of the portfolio, we can say, okay, let's make sure on a pension payment day at the end of the month that we have at least, you know, 65 million maturing. So that we, you know, it's an anticipated outflow. So we're not scrambling. We don't have to sell something on short notice. So the big ones are payroll. Office of Public Instruction makes distributions to the schools once a month, and then pension payments at the end of the month are kind of our big ones. Other ones we've put on there is John wants 50 million at the end of next week to buy equities. We can put that on the calendar and make sure that we have enough rolling overnight to meet those demands. So
And the green are what's expired?
yep, so the green, the light green, the sage, is that? Sage is what we own. That darker green, the Chesham that's on screen. So again, an example, previously we'd have to erase it and rewrite it in the book. So that was a called security. We bought it, the maturity date was September 2nd. The dealer said, oh, we want to call that security. And so we, you know, as easy as a click and a drag can now show that was actually called Wednesday and it's no longer a good maturity for September 2nd. So we've moved it forward.
Oh,
Again, it's a dynamic way of kind of visualizing which We're all visual people. We all use pretty colors. So,
So
yeah,
we-
just an
so we need to
improvement in
make
the
sure the
process.
state keeps Microsoft.
Yeah, that would be.
We could probably go to something else if we had to, but God bless the book, but this has made it a little bit easier for planning purposes. Go ahead and give it back to John to talk about state fund.
Yeah, well, thanks, John. Yeah, and again, I want to thank John Carpenter for developing that system. We had thought hard about ways to get around, and I think the board had expressed concern, around the, hey, what's the story with the one book? And, Chris and I just weren't able to find a viable solution, and that John stepped in and figured it out, so thanks. And I hired him, so.
So when you- does that auto-populate? Like when you buy, does it just plug into Outlook or how does it, do you have to
Not
go in
yet.
and create it?
Yeah, there's a little bit of an import process that takes.
You don't have to type it, you just import it.
Yeah, correct.
Before you move on to state fund, I want to ask you about in your, how often do you get surprised by the requests for cash? I guess particularly, those would generally come from the expendable fund. Is that right?
Yes, so
Treasurer's fund?
And
from those expendable funds, we're not often surprised. Because Kelsey particularly, and I work with them and try to know. Operating funds, yeah, well, sometimes we're surprised. And so we just have to build that in, and Kirsten and John and Kelsey are just understand that they have to be flexible, and the state treasurer might call them up or email them and say, oh, hey, you know what? There's a second ACH for 13 million going out. Sorry. And so Kirsten is expected to scramble around and find $13 million, and often almost always she can, or John and Kelsey can. So we have provisions built in, and obviously Kirsten trained John and Kelsey, and I think she's trained them well to understand not to panic. That we'll just figure out a way to do it, and they're very good at being calm and just working through the processes that we have, and finding the pools of liquidity that we keep, and getting those transactions pushed through.
so is that a monthly occurrence or twice a year? I mean, just.
Yeah, so I'm sorry, I'm gonna defer to Kirsten on how often are you getting surprised by big dollar figures?
More lately, but I would say it's, maybe once a month it happens.
A request for cash.
An unexpected large request for cash, or the bigger problem is a late in the day large wire request. Because we finish our, I finished up, I come in here, there's, US Bank, our state checking account has $5 million in it. So if DOA says they need 15 today to wire out, they don't have it. So we have to then go find an additional, $10 million for them to send out. And it's a time crunch.
Can the board, somebody set a policy that you have to, if you're going to request it, do it by this time, or?
We do have those in place, but I guess we still answer to the DOA in general, so we try to make it work.
We could technically tell them no.
And you don't want to.
We don't want to be in that. I mean, when they call, it's a how can we help, not a
Yeah.
sorry.
That's very flexible.
I can't think of one where we haven't been able to accommodate.
Well, there are a
I mean,
lot
once
of,
in a while, there's a certain time frame. So if it's 2 o'clock or something, it's like, well, there's nothing we can do. But
right, And there are, I
They
will
fix
say, a number
those.
of wire requests past the cutoff for today. And then I usually ask, our treasurer, I guess it would be, can you ask that agency if they can pay the date? It's a process for us, and usually it's not I'd say 9 times out of 10, the agency did change the date on the form and they're fine with tomorrow. So that's good.
The ones that get us are when there's like a legal settlement and the money has to go out on a certain date. Those are, that's just, okay, somebody's new somewhere and didn't get it in. We've got to fix it.
There would be, it would be highly unusual that you wouldn't have advance notice. I mean, somebody didn't give you.
Somebody didn't give us the notice,
Yeah.
right?
Really?
Somebody's new
I
at
mean,
some
you-
other agency and didn't.
The
have
time
it.
between you, when you settle a case and when you get the cash, is usually significant.
Yeah, just that they didn't tell us.
The
Just they
agency,
didn't tell you, right.
agency didn't inform them.
Right.
And all of that's gone out multiple times. Please tell us if you have things that are greater than $1,000,000, whatever. Still happens from time to time.
We've got,
Dan said we're pretty good at
we've got protections.
at this point.
Well, otherwise just we get bored.
Yeah.
There's usually donuts the next day after we have something like that.
All right, thank you.
All right, going on to another large account that we manage is the state funds, state workers' compensation insurance fund, or state fund. So that's about $1.5 billion that we manage for them, and it is across most asset classes, including constitutionally allowed equity in that fund. So the strategic objective of the state fund is to attain returns that assist the fund in meeting their liabilities, as well as maintaining a stable and cost-effective rate for workers' compensation insurance. The investment objectives are mainly to provide income by taking some prudent risk and preserve principal by diversifying the portfolio across various risk factors. So you've seen us come to the board recently with a request to allow high yield investments in state fund. And so that was a way to increase the yield without concentrating risk in one of the other existing asset classes. And you may well see us come to the board again with additional asset classes. And of course, the secondary investment is long-term capital appreciation in excess of inflation.
So John,
Yes.
would these investments then be like separate accounts then, because not every fund can, every account, I guess, can invest in those? Like equities or,
So state fund is a separate.
it is its own account and its funds are. Well, that's what I was looking at this chart and trying to figure out. I'll ask my questions outside of this.
It gets back to the conversation yesterday about how do we do the quarterly report? Should we report on the pools and then get into the asset classes, because the asset classes are owned by multiple pools and by multiple separate accounts? So what's the, but that, to this point, yes, core fixed income is in everything, but equities won't be, real estate won't be, but is in most. Real
That's-
assets probably close.
I was
But
looking at,
state fund stock equities is in cap, right?
No,
No?
equities are in state fund as well.
What's that?
State fund has equities as well.
But he's saying.
But they're not managed in cap?
No,
no,
Oh.
They're managed by the managers.
and we
Well,
allocate them.
we only have passive equities in state fund. So they have a passive domestic
Well-
equity and a passive. international.
Oh, okay.
Their cash is with BlackRock and Northern, or their equities with BlackRock and Northern. But that gets, I mean, again, here's the asset class.
Commingle.
They're not quite, they're not commingled.
So back to kind of where I was I'm looking at this chart
Mhm.
because I used to work at one of the university systems, of course, and we, in our budgets every year had investment earnings. But those come through the state treasury, then those earnings, separate from these operating funds that you have, or I'm just trying to
It
understand.
depended on where your cash was. So Ochi cash is in treasurer's fund,
Treasury.
but the universities have their own cash.
Are those for other than general fund type funds?
Yes,
Okay, that's what, I just want to make sure
those are everything.
I did this for
operating
30 years and
in-
I'm thinking, God, I thought I understood it, but I'm not sure now. So those are other operating funds. This makes more sense.
Going on to slide 21, we already bragged about being cost effective. So, and I believe the CEM information is being finalized, so I'm sorry, I don't have an updated number from 2019 there, but it's in the same ballpark.
But the difference between the ETF and your cost is pretty stunning.
Well, the costs will go up by one if the
Okay. But that's spread across a pretty big denominator, so. Might not be glaring in terms of. Wanted to talk about some of the resources and we're gonna show you some of those, but of course, the primary resources is the Kelsey, Kirsten, John team. We do use Bloomberg for many things, including some portfolio analytics. We have external managers that we'll talk shop with, if you will. And then, of course, referring back to that slide showing the transactions. I mean, we couldn't do that without operations and accounting. And not only did we get a new FTE, but we foisted some of our old duties off onto Tim and the ops team. And that freed us up to greatly increase the number of transactions and volume of transactions that you saw. 52 billion's a lot. And we thank them for it. And the only thing we can do is make their day worse. And the only thing they can do is make our day better. And so quite often we buy donuts. We also use a few other credit research external providers. The main one is Credit Sites. Credit Sites is the gold standard in corporate credit research, if you will, and they do an excellent job of industry analysis and they do an excellent job of tearing through financial statements and 10Ks, the form sent to the Securities and Exchange Commission with all the information. And so John and Kelsey and I don't spend time going through 10Ks. We let Credit Sites do that and summarize the information for us. And then we do have brokerage contacts. And so we're using those more on for economic research, maybe research on an asset class. Rarely do we care what a broker's opinion is on an individual security. Their opinion is always either buy or sell it. Never hold.
Wonder why that is.
Yeah. They're not like me, famous for help. So my latest nickname is Kim Kardashian of fixed income. Why?
Yeah, I don't know. I have no idea.
Famous for doing nothing.
Who gave you that one? Kelsey.
Yes.
I told you it was a mistake to move her.
Doing nothing is usually the right answer, and it don't, just because a broker has something for sale doesn't mean we have to buy it, so.
That was one of my lines with clients. Was sometimes I do my best work when I do absolutely nothing at all.
Well, bravo, sir.
Still billable hours, though, right?
No, that's the problem. So how would you break it down in terms of percentage of your time you spend buying and selling and working on the calendar, and how much you spend researching?
So it's gonna be different for different members of the team. So for Kelsey and John, and I'll let them speak to this, they probably spend the majority of their time researching credit. And that's our ask of them. For Kirsten, she likely spends the large majority of her time trading and preparing to trade. But she's also responsible for credit research. I spend the majority of my time on portfolio analysis and presentations and some other duties, but I also am responsible for companies and credit research. So when we came up with that, I guess I didn't want to put the team in the position where I sat around trading and they sat around coming up with good ideas for me to shoot down. So I thought that it would be beneficial for the team if they all traded. I feel like it keeps them engaged. I feel like there's an intellectual aspect that I am very confident in all of their intellectual capacities and ability to analyze, but I feel like there's an emotional aspect as well. And when you're actually got to pull the trigger, that changes your outlook. That might change your outlook emotionally. And so that's important. I think it broadens their understanding of markets and the process. And heaven forbid, in my case, of getting hit by a bus, then they could step in and take over. And so that was just the philosophy. But, I guess we would call that an expanded team concept.
I thought sure you were going to say the majority of your time was in my office complaining about how the yield curve hates you.
Yeah. That's portfolio oriented.
That's right. That's portfolio man.
But yes, that's just a technique.
Right.
So referring to slide 24, I think that says, that discussion of our experience. I think John and Kelsey being on the team for over 2 years now, with also additional history of financial analysis, certainly helps. Kirsten's anniversary was 6 years at the beginning of August, and so and again, she had experience prior to that. So I think we've got a well-experienced team now that we're not afraid to kind of let run. We have a well-defined investment process. We talked about, some of those guardrails and what we're trying to do, low cost structure, the control that gives John particularly to tailor characteristics of a portfolio. Obviously, we've got good long-term performance across the portfolios versus benchmarks, and feel like the internal management is a core competency. So with that said, we're going to demonstrate some of the stuff that we do on a daily basis. And so
What's that? Can you? Just like for a week? Before my term expires, can I get the keyboard for like a week?
Yeah, absolutely.
Yeah. We might have to put Tim on overtime, I think.
After we're done training the interns, you know.
Yeah, then I come, yeah, thanks.
Again, thanks to John and Kelsey for training the interns on Fridays, every Friday. An intern, almost every Friday, they'll come in, even though it's a work from home optional day, they'll come in the morning to trades, just so that one of the interns can sit with them and have the opportunity to engage and trade. And one of our goals is that they could get $1 billion in trades in. And so we think that's a nice little resume builder, a nice little smooch to the resume. So, but you know, it will obviously would be easier just for John and Kelsey to do the trades at home, but they're willing to do it. And
So when they do their report back to school, what did you do this summer?
right, $1 billion of trades. What'd you
$1 billion
do?
trades.
We had an intern, Robin, who was called a friend of hers that was doing an intern for I won't say the brokerage firm. And that person was out sweeping the parking lot after Robin had done 100 million in trades. But anyway, getting back to what we do on a daily basis. So this is the Bloomberg port system. Right now I've got the trust fund investment pool pulled up, and we'll look at that and say, okay, how are we doing? Well, yay, we love to see these green numbers. This is the actual number we're looking at. Yay, 2% or better up for the month. So that's real good news.
Why is zero sometimes pink and sometimes green?
Rounding.
Oh, is that right?
Yeah, so if we'd taken this out to 20 decimals, then you would see
I get it.
plus or minus. Thank you, Kirsten. So this, you know, negative, boo, getting beat up a little bit by the market here. We're underperformed on the quarter so far by 14 basis points. So then I look at that and think, well, okay, well, what can we do? Let's take a look at a portfolio metrics here. And so I'm looking at a few things. What is our yield in the portfolio? In this case, we say yield to worst. Yield to worst because sometimes securities are callable or they'll pay off at different speeds. This assumes it works out the worst for you. Why? Because it almost always works out the worst for you.
Because the yield curve hates you, right?
Yield curve in this case hates everybody. So we got a yield advantage at 10 basis points. Is that enough to offset it over the year? Maybe, but where could we get a little more yield advantage? I'd like it if it was better. So we might look through here and say, okay, well, what's our contribution to duration on an individual security type of basis or asset class basis? And so I'm looking at this and saying contribution to duration, think risk. I'm a little like the index in risk in corporate securities in the trust fund investment pool. Not a lot, but a little. You know, is that an active bet I intend to take? No. Yeah, I would probably want to be neutral. So then I think to myself, well, then we, you know, obviously corporate securities pay down, so we've got room to buy those. So then I might throw out into the chat, hey guys, I'm thinking about putting on some risk putting on some corporates. Any ideas, any thoughts both on, in terms of any reason not to do that? Is there any big economic things happening recently? Can't think of any big economic things happening recently. Or do you guys have ideas for what corporates we might want to buy? And so keeping in the theme of any significant economic things happening, Kelsey is going to show you, for instance, the Fed's expected rate movements. And I will stop the share so you can do that. Sorry.
Okay, good morning, Mr. Chairman and members of the board. What you're looking at here, and actually, Dan, can you move on the Zoom screen? Can you move the picture to the left or the right?
Can't you actually
There.
minimize that to where it's
Oh, that's much better.
I can't get rid of it, but I can move it.
Yeah, that's
So
perfectly fine. Thank you. So what you're looking at is a Bloomberg screen called WIRP. It stands for World Interest Rate Probability. This is the likelihood of interest rate changes into the future. So just a quick overview first of this screen. On the left, we have different geographic regions: North America, Europe, and Asia Pacific, and then countries within those regions. The top half of this screen has interest rate data for the US region, and then the bottom is just a visual representation of the numbers that we see at the top. So we are looking at the US region for today, and the FOMC meets 8 times a year to determine the target rate at which banks will borrow and lend to each other their excess reserves overnight. This rate is part of monetary policy used to promote economic growth. And currently the FOMC is trying to reach price stability. Those are their key words. By raising rates, they can lower inflation and hopefully reach a soft landing. You may hear that in the news. John referred to that yesterday. That'd be lowering interest without causing a recession at the same time. So first, I'm going to highlight important parts on this screen and then show you an application of how the data changes day to day. So at the very top, we have the target rate. This is a target or a range of rates for trading in the Fed funds market. And banks can negotiate this rate between each other. So that brings us to the effective rate. This is a weighted average of interest rates across all of the transactions. Below that, we have all the future meeting dates and the number of hikes or cuts priced into the market. So when we say that a hike is priced into the market, what we mean is that the current rates of securities trading today reflect the yield calculation as if the rate hike will happen in the future. So this is important in STIP because if we don't anticipate what the Fed will do, we could buy a security with a much lower yield than what it ends up being for that time to maturity. So another way to say that, in using an example of extremes, is let's say the Fed is going to meet next week. And we in the market, everybody expects the Fed to raise by 2%. That would be a giant move. We wouldn't want to purchase a security that's yielding 0.25% today, that has a 3-month maturity, because we're locking in that super low yield and we're not aware of what the market moves may be. So moving across in the columns, next we have implied rate change. This is just merely taking the number of hikes that are priced into the market and multiplying it by the assumed rate move, which is over here on the far right, 25 basis points. And next column, we have the implied rate. You can see that the terminal rate as of the end of this year today will be 3.408%. That's a projection, not a guarantee, of course.
But
So-
that's priced into the market right now.
Correct. So then down below, you can see the visual, which is helpful. What we're going to take from here is that we expect rates, the market expects rates to increase, topping out at 3.44% in February, and then decreasing, cutting thereafter. So for the application, what I'm going to do is I'm going to change the pricing date at the top. This is currently for today, and I'm going to put in the date of July 12th. This is an important date because this was a date prior to the last Fed meeting, and it was the day before the latest CPI data came out. So this will update, and pointing out here for backdating the information to July 12th, you can see the next meeting is for July 27th, and the market was pricing in almost 75 basis points for the next hike. Now I'm going to change this to July 13th, which is when CPI came out, and it was expected to be high at 8.8%, and it came in higher than that at 9.1. So the market reacted. And again, you can see this implied rate. This closed for the day at 90.7 basis points. It was as high as intraday, as high as 93 basis points. So that's a significant move for just one data point in one day. And important for us to keep tabs on this screen and see what's going on, especially as these meeting dates get closer. Just another small point additionally with the different geographic regions, we can look at different countries. For example, Canada raised their rates 50 basis points in April, and then the US followed suit with the same 50 basis point raise in May. Just today, the Bank of England made news because they raised their rates 50 basis points as well. That was a significant move for them. And we look at these different regions and keep them top of mind. Number one, because we cover the international bank sector, and we purchase those securities, particularly in STIP, but also because we don't operate in a bubble. So it's important for us to know what's happening around the world. This is just one screen and one thing that we look at every day or periodically, so that we can be sharp on evaluating what's happening in the market and trading. And John mentioned earlier, if we were to add in corporate securities to our portfolio, we have many other things that we're looking at as well, some corporate credit metrics, and I will turn it over to John Carpenter to point some things out there.
So what we're looking at here is, so as John mentioned, we each are assigned a sector, well, several sectors of the economy, and then we cover approved names within that sector. So for instance, we're looking at the capital goods matrix, which happens to be one of mine. Twice a year, we do a deep dive and a presentation to the rest of the fixed income team and evaluate our companies on a 10-point scale. So 10 being, and it matches up nicely with investment grade, a 10 would be a AAA company. A 0 would be, not investment grade. So 1 point would be BBB minus, which just kind of works out that way. And so, as part of what we do is not just presenting these twice a year, but also, as John mentioned, keeping up to date on current topics. The big thing we had yesterday, Mondelez, which happens to be the maker of Oreo, announced that after 5-year hiatus, they're bringing back pumpkin spice Oreos. So Kelsey threw that in the chat, and we immediately decided that that was a buy-worthy event. So
It's a food culture. Does anything other than food move the index?
yeah, that's the biggest current example anyway. So we're constantly looking for those ideas. If there's, a company reports earnings and there's something concerning, we'll throw that in the chat and have a discussion. Is this a big enough move that we need to get out of the name? We haven't fortunately had very many of those in the last couple of years. Again, we're buying investment grade securities, so hopefully, but again, stuff happens. So what we did as part of a summer internship opportunity is shout out to Ethan and Halton. I tasked them with going into Bloomberg and evaluating any numerical metric that we use to make sure that it's still relevant. So economies change, companies change, industries change. So if we gave a point, the example I'll go into is market cap. So what we did is evaluated the S&P 500 and just looked at investment grade companies. So there are companies in the S&P that aren't investment grade or don't issue debt and aren't rated. So we excluded those and just looked at market cap for an example. So previously we decided that between 10 and 50 billion is kind of where a company should be. So that's adequate access to the capital markets. So if they were in a cash crunch, they could go out and issue equity. Anything smaller than that, maybe that presents more risk. So we would give that a -1 point. Anything above 50 billion, maybe we feel more secure and are, give them the full credit and would give them a point. By evaluating that metric, we decided that our range needed to shift. So in the last 5 years, the S&P 500 is up 60%. So maybe 50 billion is no longer safe, right? So a good example of that is Activision Blizzard was just bought by Microsoft. It's a $58 billion company. Well, okay, maybe 50 isn't the number anymore. So they did some math, some statistics, gave them an opportunity to apply their college classes to a real world example. And again, this is something, their work isn't sweeping parking lots, which is cool, but they're having a real impact on how we look at companies. Again, this was with oversight. So the example here is Illinois Tool Works. That's a $65 billion company. So 6 months ago, we would have given them a point because they're over the 50. In this case now, we're saying, well, 65 maybe isn't as safe as we would like to see. If you look at their peers, Lockheed Martin, Deere, Caterpillar are all right around that $100 billion mark. So again, this is just one numerical metric. We again use our judgment, our common sense when we're evaluating these things. There's a lot of non-numerical stuff that we look at as well. Do we believe in the company? Do we like their management? Are they making headlines in the news? Okay. Made a face.
Sometimes I walk down the hall and say we should take people off the list. You're like, no, I don't care.
We all have different ways, I think that evaluating things, that makes us stronger.
And thank you guys.
So again, that's just a microcosm. We're slowly integrating these. We don't want to make huge sweeping changes before we make sure that the change makes sense and kind of fits in with where we believe a company should be traded. So with that, I'll turn it over to Kelsey, and she's got a visual example, which we'd like to see.
John? This is another Bloomberg screen, and this is the FIW screen. You've seen something similar before. This stands for Fixed Income Worksheet. And so what I have populated here is that same sector, the capital goods sector, and just 3 of our approved names in that sector: Caterpillar, Illinois Tool Works, and John Deere. And this is a graph showing the G-spread on the y-axis here. A reminder, the G-spread is the difference in basis points between the yield on a treasury and the yield on a corporate bond of the same maturity. So generally, the higher the G-spread, the higher the risk on that bond to compensate for the risk. One thing to mention, yesterday, Jim said that typically in times of recession, you see greater spreads. So you can visualize this graph, and a greater spread would mean that these bubbles are higher here on the chart. The white line is the regression line for these three companies. And you can notice that all three companies are trading pretty tightly, both to the curve and to each other. Other sectors that we cover, you will see differences in this. For example, food and beverage. You may see Coke and Pepsi trading quite a bit lower than their regression curve. And then you may see a company like Altria, which is in tobacco, trading much higher because of the risk involved.
So is each dot a separate bond?
It is. Yep, exactly.
Why-
That's
Why is it that you got Caterpillar 08? You know, you got that, well, so you
Right
got
here.
Caterpillar 08, you know, way above the line, and then 09, and it's same, almost the same length, 09, way below the line.
so the 0.8 that you're seeing, that's the coupon on the bond.
Oh, okay.
So
Oh, okay.
uh-huh.
What was issued would be the
Yes.
determine why
If-
the one is at 09 and one at 08, because they were issued at different points, right?
Correct. If that's a fixed rate, yes, it will, that is the coupon rate that it will stay at. So yeah, that brings me to my next point. Each one of these bubbles is a bond issue. They're all labeled with their tickers. If I hover over these, there are additional details there. So back to what John was talking about with credit metrics and the scoring. When we give each company a score, it gives us a quantitative evaluation in addition to this FIW screen. So it just gives us more information as to the risk involved and where we would expect these bonds to be trading. So I'm going to point out down here, this Illinois Toolworks at the bottom, because it's hovering pretty low here. If we did decrease our overall score with some of these metrics, we would therefore expect to receive more money for that risk. So we would, when a company decreases its score, theoretically, we want to see it higher on this chart. And if we decrease the score and we see this bond hanging out down here, we might start reevaluating. Should we get out of this bond? Should we swap it for something else?
So these aren't necessarily bonds that are available to buy. These are bonds, you may not have that particular bond, but you're looking at the company and how the market is looking at that company.
Correct. So we do own a few of these, not very many. I think we might own this CAT bond that matures in 2025, but we do not own any in our Illinois Toolworks at this moment. But if we did, this
That
might
would
be
a signal.
a tool to say, this isn't in line with what we expect, and we want to be compensated for the risk that we're taking on.
We want it above the line. general?
In not all cases, I mean, if it's below the line, which is just the average of what we're seeing here, that would be a company that would have lower risk, and so,
I think Microsoft is always going to be inside that.
yeah.
So we want to buy above the line and sell below the line.
Okay, well, that's why I'm looking at this chart going, well, that means absolutely nothing to me. I'm thinking, well, how would you use that looking at this chart? That's what I kind of was.
And you can also pull our own portfolio into this screen and see where our bonds are.
Okay, that makes sense.
So if we had decided on Illinois Toolworks was the company wanted because of John's credit work, and he said it rated a 2, then we'd say, okay, well, we sure don't want the ITW 265s of 25. We would rather have the 350s of 23.
Why are those two bonds from the same company different?
The market values them. It's an inefficient market. If it were a perfectly efficient market, every bond would be on that line. And so when I tell you it's an inefficient market and we can profit from that, It's because other market participants value those bonds differently than we do.
But, and that's what we know. I
Yes,
mean, we
these are
know
based
that
on
from
actual
this,
rates.
but what about the why? Why is it valued?
Because another participant might say, well, hey, Illinois Tool is a A-rated bond. And so it should trade tight.
Okay.
And we might, and based on our evaluation, we say, well, really, no, we think it's a 3, a triple B plus bond. And so our goal with our credit metrics that John showed you is to have our own independent evaluation of the collectability of interest and principal of various companies. So that we can trade bonds or find bonds that fit our evaluation of risk.
From the population of companies that you deal with.
Impact does a corporate earning, because I know Caterpillar just had disappointing earnings. Do you see that reflected pretty quickly in this, or because they're different?
Yeah, so we see it reflected, but the bonds are traded by appointment, over the counter, so to speak, and so that means you gotta contact a willing seller to buy that bond. So it takes more time certainly than the stock market.
Yeah.
And usually the movement is less.
It's muted, yeah.
So pointing out something obvious here on this curve or this, this is an upward trending slope line, which is what we want to see. The longer term maturity, the greater risk, and you want to be compensated for that. So at times we see curves that don't look like this at all, maybe more like the treasuries right now where you have an inversion. But this is a nice healthy line. And you can also see that the bonds are in a fairly linear line. It would be unusual if we saw bonds all over the place.
Like outliers on it.
Exactly. Yeah. Yeah, this is a nice
What
example.
would that mean?
Usually it's that the price is stale. It's a small issue. Maybe there's only 250 million of this bond outstanding and it was traded 3 months ago. And so it looks high and then we go, oh, we need to go buy that. And you can't find it because it's stale data.
So is the fact that it's tight to the line and that the line goes up, is that a reflection of the fact that your research that these are good companies is correct?
Well, it's a fact that the market believes that. That might not be what we believe, but.
Right.
So to follow that up, if you had whatever this category was, I forget.
Capital goods.
Capital goods. If you had all capital good companies on there, you'd see them all over the place because of the different ratings and the different strengths. But this is your pre-selected of the approved list, so you've already done that research.
Right. Right. And sometimes, I'll look at just one company in relation to itself. So I can see where those bonds are trading. If it's a new issue that comes out, I'm curious to see what just that one company alone, and then I'll expand it to the approved list in the sector. Just more information.
Kelsey, are you looking at this because are you looking at this all the time, or are you looking at this because you get a word that we need to buy bonds in this sector? Is that a good, do you understand my question?
Yes. Sometimes, I might look at a different one of these charts every day. And it is motivated by a different reason every day. So yeah, maybe earnings come out or there's a new issue. That's oftentimes why I look at this specific chart in FIW. Or to see, what we have and are there opportunities to make a swap somewhere?
So are you guys communicating that every day about these kind of things through the chat, or you're not all in the office all the time together, so? right?
Yeah, we call it the fixed income chat.
Chat, that's your chat. you
And
were talking
are
about
we
earlier.
safe to show the fixed income?
Yeah, there is nothing in there.
Just don't show yesterday.
No, it's not 100% about investment. But
Dan keeps saying no.
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 Hard pass.
yeah, so yeah. If, you know, a lot of times we are in the office and we'll yell down the hall. But a lot of times we're not, and we throw it in the chat. And
I was just curious how timely that is, you know. I mean, are any of these time sensitive when John was out fishing in his pond outside of his house or something? And missed that message. I mean, I'm just curious. Are you right there all the time watching for these kind of conversations or?
yeah, well, I mean, you definitely can miss something in the chat, and it happens for me quite often. You know, I'm dealing with, for instance, the got to get the board book out, and so I might miss something. So within broad parameters, the team is empowered to trade. And so if we have 2 meetings a week well, hopefully in person, but sometimes it's over Zoom. And one meeting is a discussion of portfolios and one meeting is a discussion of credits. We used to do it together, but just got too long and our attention spans are, 45 minutes tops. And that's nearly the record. So John usually will attend the portfolio meeting, not the credit meeting. He doesn't care about the credits anymore. He can help himself a little bit, but yeah. But so in the portfolio meeting, we would have said, hey, in the trust fund, we probably have a little room for corporates. And so if I'm not there and they buy corporates, I'm okay with that. And so they don't have to, if I'm buying a corporate, I throw it out to the group. Certainly a courtesy and I get good information back that might say, no, don't do it. Or yes, that's the right one to do, but let somebody else do it. So we don't get Ramascoed on the trade. So, and that's a real thing. And I don't understand it. It should be statistically impossible, but where we would have a problem is if they said, if I said, hey, state fund is full on corporate, we're 175 of the index contribution to duration for corporates. I don't think we have anymore. And if one of the team bought corporates and state fund, then we'd have a discussion of how, let's not do that. That doesn't happen generally. We're a team and we are on the same page.
Did you hear that?
So that completes our fixed income demonstration for you all. We want
Perfect.
to thank you for your time. We really enjoy showing you what we like to do here. Any other questions? Great questions so far.
I have one, Mr. Chair. Any other tools that you're looking at or you feel you need to be more?
One tool that we're looking at is TradeWeb, which is like market access for electronic trading outside of Bloomberg. And the virtue of TradeWeb over market access is its ability to trade treasuries and agencies and or treasuries and commercial paper. And so Kirsten might compare that to the boom system in Bloomberg and find that there's some value there, or she might not, in which case we would say we're certainly not going to force her hand there.
So in that case, you'd have both systems?
Yep.
Anything else?
Thank you.
Very interesting.
So, I was around when we sort of started this whole process of doing these deep dives, and they're incredibly helpful when you guys
Oh, yeah.
put as much work as you guys obviously put into this. That's one thing.
Well,
So,
even building this.
right,
See what they're doing.
right. It's so helpful to us, and I think it's important in all of that business. And then secondly, I just Thank you. We're so lucky to have you. I don't know how else to put it, but I really mean it. And
Well, Kirsten and I always, I think we always tell everybody we've got to have the funnest job at the state. And hopefully that gives you a flavor for why we say that.
well, spectacular. Thank you. It's wonderful to see you. Can we take a quick break? Sure. We'll take it to 5. We'll be back at 11:35.
You know
You're
how
ready
these
for it.
things can go on.
So you reviewed everything and you got the money reserved for those loans? Is that what that is?
So the reservation process is basically the lender paying the quarter basis points just to reserve the funds. So they've just got the interest rate reserved and the amount reserved at that point. And then the next step for them would be is to submit an application, at which point I do my review. And then it goes to the
And is that reservation only good, that 4% or whatever it is, only good for so long?
the reservation is good for 1 year. And
And then they have to buy it again.
Have to do it again.
right, if the loan doesn't close within that 1 year period, they can extend it for another year. They can actually, they could actually extend it for 2 additional years. So they can lock in a rate for 3 years, which is very good, very good. And if the rates go lower, they can walk away from their reservation and get the lower interest rate, but we keep the reservation fee. We always refund the last reservation fee paid. But we keep. The IRP program reflected a balance of a little over 4.9 million, which is 39 loans. The yield on that is always 2%. And we have 1 committed loan for $500,000, and there's no past due loans. The science and tech portfolio has a balance of over 7.8 million. It's 3 loans, and the return on that is 2.76%, and none of those loans are past due.
So Doug?
Yep.
Science and tech portfolio.
Yeah. We kind of lump everything as far as Montana State, I believe, is one of them.
Montana State and Montana Tech are the only 2 left.
Oh, this is that MS.
That's at 1989.
Yeah, I remember that, so, okay. That's what I was wondering.
U of M refinanced all their debt, paid theirs off, but
Just the Missoula account.
right.
The Montana Facility Finance Authority portfolio has a balance of a little over 12.6 million. It's 15 loans, and the return on that is 2.56. They have 2 reservations, almost 1.5 million, and none of their loans are past due. The Veterans Home Loan Mortgage Program balance is almost 48 million. There's 273 loans, and the yield on that is 1.66. They have 4 reservations for almost $1 million with a projected yield of 3.06%. And there's 5 loans over 90 days past due, totaling a little over 935,000, or 1.95% of the portfolio.
And these are guaranteed though, right?
Yeah, they're either guaranteed through the veterans guarantee, or they've got a couple of FHA guarantees also in that.
Okay.
So, okay, given that, that means that we won't use that $5,000.
Right.
What was that? Say that again?
We're gonna recover the 900, even though they're past due.
If they went into default, I mean, like foreclosure.
Well, so how long would that period, timeframe be to make them go into default?
Well,
6 months, is it, I mean, when do we make that determination?
We don't, first of all, do we?
No.
Yeah.
The Board of
We don't
Housing,
make the
Board of-
the
determination.
Board of
I
Housing,
don't mean, I mean the greater we.
yeah. So the Board of Housing administers it. There's certain guidelines that you follow when a loan goes past due. And, you know, typically at 90 days, it triggers events where you have to provide letters and start the processes to foreclose on the property. The multifamily Coltest Trust home program balances almost 5.8 million. That's 5 loans. The yield on that is 2.6. They have 3 reservations totaling a little over 9.1 million. Projected yield is 2.46. No past due loans, and then the remaining balance is a little over 57,000. So most of their funds are committed for that. The residential loan portfolio balance of 1.8 million, which is 52 loans, and that's at 6.28%. And there's no loans past due over 90 days in that program. And then finally, the down payment assistance program, the balance on that is a little over $1 million, which represents 5 loans. There are currently 28 loan reservations for almost 22 million. And we've committed to 23 loans for a little over 14.5 million.
Is the 23 out of the 28 or is the 23 added to the 28?
20.
You have 23 loans committed and 28 reservations. Is that out of the 28 reservations, 23 have been committed?
No.
Or- No.
No, it's separate. Yeah, those 23 reserve or 20, you got reserved. 28 reserves still need to get to that committed status.
Okay, that,
So there's 51 in the pipeline,
Yeah, 28,
28 and 23.
51, plus we've got, you're right, in the pipeline as far as to be funded.
Right.
There's total of 56.
Are we approaching our deadline on that big one?
Yeah,
Anywhere?
no. It's Monday. Today we've, this was as of July 1st, but as today we funded 10 loans. And we've got 2.35 million funded out of those committed that were listed there. So the amounts increasing.
5 loans, it's 10 loans.
It's 10 loans today. So in the last month, we funded 5 more loans.
so that residential loan, is that one guaranteed? The one
No.
that's past due?
Well, yeah, that one that is past due is guaranteed by FHA. That one happens to hold the record for the number of foreclosures. I believe they're at 15 or 16. So on one house, you go through the foreclosure process and you can bring the loan current at any time before the sale. And even at the sale, you can bring it current. And
People just takes more reminders than others.
still got a 6.28. Well, clearly they have such bad credit, they couldn't get another mortgage, I'm sure. after
Yeah,
15
6.28.
Yeah, I
They've
don't,
got 15 foreclosures on their record. They've got bad.
the amount that they've paid in attorney's fees is just sad. No offense to.
Yeah, not that there's anything wrong.
It's just, it's mind boggling that
They went through that.
that they just don't make their payments because they allow it to go past due and then they pay it. How much, I mean, is it a 30-year? You're gonna have to live with this for another 20 years. Now, most of this is a seasoned portfolio, so, yeah. We haven't done a residential loan for 11 years now. And so this is a seasoned portfolio. The risk in this portfolio is extremely low because everybody's paid so long on it. And it's, the drama. One other thing, I just wanted to get back to you in regards to the questions that you had yesterday regarding Dakota Business Lending. There's several questions that were brought up that I couldn't answer, and I think one was Bruce as far as competition. I talked with Christy Williams, who is kind of the manager of Dakota Lending in Lewistown, and they would compete with Snowy Mountain Economic Development. But currently, they're partnering together to help fund a project. So both of them are putting money into it. Dakota Business Lending's, I guess, expertise is in the SBA 504 loan program. And so that's something that Snowy Mountain Development does not do. And so they are competitors, but they do work together. And they have similar products, but like I said, Snowy Mountain doesn't do SBA 504s.
That's to the benefit of the community, in fact,
Yeah,
both the competition aspect and the fact that what they offer doesn't overlap
right,
totally.
right. Yeah, and the fact that they can work together that's pretty neat. You know, in a small community.
All right, anything else for Doug? Thank you, Doug. And last and certainly not least, Louise,
Thank you, Mr.
tab
Chairman.
9.
Members of the board, I'll be very quick so you folks can get out of here. So fourth quarter for the intercap summary, you'll see that I did a little bit of a change there on the very top on how that bond is represented. Representing that as outstanding and also what's available to draw on that loan, so, or that bond. If there are any questions on the activity summary, I'd be happy to answer any of those. Okay, seeing them, we can jump over to the staff approved loans. This is the staff approved for the fourth quarter. Were there any questions on the staff approved list? It's gonna be easy peasy. Off we go to the annual report. First of all, we'll start with this memo. And the only thing I can point out here is that the loans outstanding from the year before, we've dropped a little bit there. And also school districts actually took the first position in the loan concentration. And of course, then city and county after that. So those are the only changes I could point out between the 2 fiscal years. Any questions? All right. The next one is the loan detail report. Remember, Cody pointed out, I did forget to, on the drawn column, to roll up all the draws in there. So if you see something, one of those in there that shows the commitment, the draw is lower than the outstanding, that's what happened. And so were there any questions in any of these loan details, any of these loans?
So relative to you also keep track of their capacity for loans,
Yes,
make sure they're within their capacity there.
yes, that's a part of our credit review that we do, is a part of the statutory indebtedness that they have. And we do it every time they come in.
It's just kind of a broader question. Has there ever been a default on that?
Never.
No, because it's always backed up by bond issuer.
No,
No, not always backed up by a bond issue, but there's a credit mechanism that you make sure is in place. Well, I guess like an irrigation district would not have a taxable base, that's the fees, right? So if the fees didn't come in as that could default, but nobody ever has, is the
nobody
point.
ever has, correct.
In how many years?
We're in our 35th year.
Very good track record.
I mean, you know,
I've been with them for 22.
What's your prediction this year? Are you gonna,
Well, I think the rates are gonna go up. I think inflation will have an impact on the projects out there.
so does that mean more borrowing or less?
I'm gonna go with less. So I'm predicting probably funding and committing to maybe under 20 million. Usually we're about 25. But these last few years, I've seen kind of a waning off of borrowing, especially with the ARPA money that's out there. There's a lot of cash out there they're still using. So once that goes away and projects start back up, I think it's gonna have fire back up again. I do like the fact that the bond that we have is with STIP now, because as the rates go up, it's actually going back to the same people who are borrowing. Basically being local government and all that. So it's kind of it's a great thing. I think it's a wonderful improvement.
I think it was so great that we no longer have that tax exempt, so you can do, I just didn't catch that when we did it. That's a really good deal.
So happy to answer any other questions,
So right now you get a reprieve before the storm hits again.
perhaps.
They just gotta go through the cash.
Yeah, it's actually good timing, so we could get this change done. Things are functioning really well. The repayments are coming in just as they should. It's a little more work for us, but it's also saving our borrowers a lot of money in the interest.
What do you mean it's some more work for you?
Just the day-to-day things with schedule questions and that sort of thing. The payments that come in, I know Shelley, she works a lot of that. We're slowly hoping to wean people onto, or wean them off of sending in checks, wiring, that sort of thing, and just having it do an automatic payment. That way our accounting people can just set it up and it's done. So this is, everything is trickling in on different days. And so it just causes a little more labor intensive, but
And August is payment month, so this is a particularly bad month, but we did the 5 basis point spread last year. Wasn't enough, so I'll probably propose a bigger spread for continuing to send checks next year, just to, our new loans are ACH and wires, but we have all the legacy loans that are still, we gotta get rid of those.
And if they do an automatic, it's, we give them a 5 basis points.
If they, so it's 155 if they do ACH or wire. It's, or no, it's 155 if they write a check, it's 150 if they do a ACH or wire. What's the 1-year T-bill at right now?
Probably around 2.25.
So, if it were today, it'd be 2.35 next year for the floor. So, add your, add some spread on top of that for not only our administrative costs, but then ACH wire expenses as well.
Okay, anything else? Thank you, Louise. Oh,
So I have a question for Doug though.
okay.
So
Well, that's going back.
Any of those ARPA loans gone south yet?
No. We don't get payments until January 2027.
You should start reporting 0 losses on ARPA payments.
Right.
Yeah, 27.
So far,
Look how well this-
no one is behind. Okay. All right. Anything else for Doug or Louise? All right, then, thank you, guys. Recap of the staff to do.
I have a proposal to the HR committee next meeting.
Well, we owe the,
We will,
okay,
What's the proposal?
right,
retention conversation.
retention stuff.
Housing, we'll have an internal conversation about affordable housing and intercap, and if there's a place we can be helpful. Otherwise, we have separate accounts review. John will have his first proposal for asset allocation for next calendar year. We'll have the CEM report, we'll have exempt staff performance reviews.
August
And
16th.
August 16th, we have a brief
Our meeting.
rule meeting. We need a quorum for that, I think.
we need a quorum for that. That'll all be,
And then also,
Policy.
hopefully we can approve the policy stuff.
yes.
I'll have it done.
Okay.
I'm pretty close.
That'll be a short Zoom meeting.
Zoom only, yeah.
Yeah.
Unless, for those of you in town, if you want to come in. But don't make a trip.
Yeah, for a 15-minute meeting. So you're going to Portland for the asset allocation discussion, and that's going to occur August 31st. And you'll have a discussion with them about your level of turnover and everything, and you can let us know how that discussion goes.
Yes.
Okay. So is that it on the to-do?
That's it on
Was
the
there anything else on the to-do? Let's adjourn.
Okay.